My opinion, and quite possibly Michael's reason, although you best ask him for why, is that not being a true market actually means we're maintaining a Ponzi, and at any moment it could go down, and then his timing opinion will come home. By the way, he's also not the first to say 4 digits. He may have been, who knows? It's not. I don't follow all his forecasts, but we've said the same. After our 333, you get 4 digits. In fact, we've called for single-digit gold-silver ratio, which will almost certainly see 4 digits in silver, but we've given it to you in a different way, without a time stop. Because I can't 100% say I can put a handle on when it all blows up, but I will say we're in injury time.
As global financial markets face tightening debt contagion and shifting interest rate expectations, gold and silver are surging toward key resistance levels, with gold pressing above $4,400 an ounce and silver holding strong near $66 amid multi-year supply deficits, while short-term profit-taking continues to create sudden price pullbacks. Major institutional targets are aiming significantly higher, signaling that the broader precious metals bull run is far from over. In this clip, technical analyst Francishunt lays out why he sees silver eventually reaching 4-digit prices and a single-digit gold to silver ratio after his long-standing $333 target without locking himself to a hard deadline. He explains the post-2020 bond market turn as the irreversible signal that debt is no longer a true reserve asset, warns that we're already in injury time for the fiat system, and stresses that his forecasts rest on technical structure rather than headline-grabbing guesses. Stay to the end. Is the Ponzi finally about to crack? Watch until the end to find out. But before that, if you find this analysis helpful, please hit the like button, subscribe, and turn on notifications so you never miss our deep dives into the markets. Thank you for watching, and let's get into the video.
How do you see the silver market playing out for the rest of 2026 and beyond?
Yeah, so I mean, I don't want to start passing judgment on some other analysts' work, especially if I don't know the assumptions. We like to think of ourselves as the biggest bull, but I think in terms of time frames, Michael certainly usurps us. I want to, in a separate vein, without directing this at the person you mentioned at all, say there also is a tendency for what I call the sort of Max Kaiser syndrome, where it turns into a kind of pissing contest of who throws out the biggest number. Again, I hasten to add, it's not an accusation being cast at Michael directly. You've got to have a foundation for what, you're putting forward. Ours is technical. We have a method and we have projected targets. So we will never say a number just because it's a nice round headline grabbing number. If it is, it's because technically that's what it generated. So we made the forecast well before Michael and others. So again, it's not about the person you chose to mention there. I don't want to wade into a brawl with other people's opinions particularly. We said 333 were in the Jerusalem Post quite well before Michael Oliver's controversial call for $300. The one difference we made is we didn't cap ourselves on time frame. And there's a number of reasons for that, because our targets are generated technically, and we have a long stop time date by when they should perform, and it's very far out. Typical HVF breakouts sometimes only use 5, 10%, 15% of that time, but it's a variable we have very little control about. And I've found from my own, as someone who puts numbers out there and forecasts in a public space, there's no point in putting your head through a noose on something you don't have real control on. Sometimes when we see, particularly now, there's a lot of behind the scenes debt contagion that is going to lead to destruction of fiat and debt. And Michael could well prove accurate, by the way. So for me, there is clearly a debt-based collapse. Inside of that, if you suddenly have a complete sinkhole, you could initially even have a sell-off in a disinflationary event in metals, and then a super surge. And all Michael's predictions, or anyone else for that matter, as I say, he's not part of my discussion or analysis in that sense, could indeed come true. We are a lot closer than we've ever been. And many people will tell you, but they've been holding it together since the 80s, all of this. Here's a key point on that might play into Michael's hands in terms of the risk he's taken in time frame, which I prefer not to take, is that post 2020, the bond market turned, and that is irrevocable. And we've said many times, it's the most important call we ever made in September. It's not the best, it's not the wisest, whatever, it's no degrees. It's the most important for reset. It is the point where nominally bonds are failing to go up in value anymore, and interest rates continue to typically grind higher despite everyone's best intentions, despite a weak economy maybe for retail, despite a lot of things, because when debt devalues, it's absolutely one half of the seesaw that sees rates go up. And just for the dollar milkshakers, and then I'll hand back, dollar was supposed to go up on rising rates. And normally in a strong economy where you are not got a debt-based crisis, if the dollar in America is growing strongly and the Fed is increasing rates, you actually get a flow of money into the dollar and into T-bills that sees both the rates go down, the bond values go up, and the dollar strengthen because of liquidity attraction. However, I highlight, we are now in the red zone since 2020. We're 6 years now where everyone's had that amount of time to work out that the reserve asset of debt is no longer truly being seen by central banks as a true reserve asset. And rates are being supported at these levels, and bond markets are being supported by everyone can buy, but hey, don't sell that. We'll let you lend against it. Hey, don't sell that. Now, price discovery mechanisms are based on freedom to buy and sell in reasonable size on an ongoing basis, where the price discovery mechanism does that. My opinion, and quite possibly Michael's reason, although you best ask him for why, is that not being a true market actually means we're maintaining a Ponzi, and at any moment it could go down, and then his timing opinion will come home. By the way, he's also not the first to say 4 digits. He may have been, who knows? It's not. I don't follow all his forecasts, but we've said the same. After our 333, you get 4 digits. In fact, we've called for single-digit gold-silver ratio, which will almost certainly see 4 digits. In silver, but we've given it to you in a different way without a time stop, because I can't 100% say I can put a handle on when it all blows up, but I will say we're in injury time.
Gold's recent path has been anything but random. After the explosive climb from the $2,000 break all the way past $5,000, Francishunt walks through the exact falling wedge continuation pattern his team flagged months earlier, and how the Hormuz flare-up briefly forced Eastern gold buyers to prioritize energy security instead. He details the precise moment they exited leveraged longs at the January peak, the longer-than-comfortable pullback that followed, and the fresh upside break they bought aggressively once the smaller weekly pattern confirmed. Right now, he sees only a 20 to 25% chance of silver clearing $121 and gold blasting through $5,600 by Christmas, with the more likely outcome a choppy range, unless a sudden demand-destroying shock hands us one last deep dip, the kind of forced selling bargain that rarely lasts. So the real question is, are you positioned for the next spurt? Or still waiting for the perfect bottom that may never arrive? Watch to find out.
In fact, I've got a chart share. This was our reading. I think we've played this period reasonably well. We don't always get everything right. This is the falling wedge, which was a continuation pattern for gold. So this is what happened throughout this period. Of course, the Hormuz kind of warmed up tail end of January into February. We had a very, very strong September. So I was in London and I was walking around Hyde Park and warning that this would be an upside break, having also warned at 2,000 we would run to 3,000 quite promptly on the once, twice, 3 times a lady. We dropped these catchphrases in so that people can remember we said that. And this has been the trend. You had a little blow off when you first ran to 4,000 and a minor correction, then you continued with a move up. You also had the twitch factor where you made the new high, you got the dump and you got flash bought again. That was the first warning of a bit of nervousness, by the way. And we did on the last day of January, before going to ride in the Karoo, alert our entire community to great controversy, also put out an X post And everyone said, you never came out on YouTube and warned us, all the free views, real angry. Anyway, say that we're exiting all our leverage long. So we'd had an incredible run from late August, September, all the way through to the end of January. It was incredibly profitable. We had a multitude of our community become millionaires for the first time. And then they closed, importantly, the ones that were listening, which was most of them. And then we went into this pullback that has been longer than people cared. But people have to realize that 2000 break, round about November 24, I think it is, I can go and check it, you've gone almost non-stop till January 26 to 5,600. That is incredible for a very big market cap. You're talking 30 trillion market cap. I don't know if it is right now. That might be just under, might be just over. But I'd have to do the maths and check. So anyway, the war brought oil into the equation. And that meant the Eastern surplus nations that were stacking gold had to now concern themselves with energy and how deep their supply chain was for potential breakdowns in the supply chain of energy. Hormuz, though, by pushing the oil, created an adversarial relationship for a spell between oil and gold, because gold is the long-term wisdom, important saving, but oil jumped in front of it and became urgent. It's not a retainer of value. Many people say, as for gold, so for oil, as if they are interchangeable. There is more scarcity to gold. It's getting more expensive to find. You would say the same to some degree about oil, but I do not assess we've ever had a peak oil situation. It's in abundance. It's not lazy age dinosaur bone juice. And we've run out of dinosaur skeletons. There's a lot of misnomer, the whole fossil fuels narrative. People need to wade their way through that. There is cost for extraction, and it is a commodity, but gold is money, and oil is not, and it's energy. So overall, there was a substitution for a spell because of the urgency that oil represented. However, as things have settled, we have worked through that. It's been about since the high here, end of Jan, and we were watching this 4,000 key level of significance that was holding. We talked about the 3 impulse falling wedge, which is unique to HVF method. There it is. And then you had the 3rd impulse here, and we were expecting a falling wedge break. And we had the smaller pattern. This is a weekly chart of gold. We had the smaller pattern, and we did the video. We even gave it to people on free view. They wouldn't have been the first. If you're in our community, you get it first. But we showed everybody this is most likely to break upside. We expect it to be midweek next week. That was last Wednesday we were referring to from the Friday before. And that YouTube remains up there. So we were buying aggressively long here. And we benefited from a beautiful spurt. I will point out you had the key spurt. Then you have a secondary spurt, not quite as big, a bit more churn, and you get another spurt. It's marginally higher high and down. So people should watch out a little bit. I would say you're a 25% probability that, silver's through 121 and gold's through 5,600 by Christmas Day. And all these stocks are well through that. I would say the majority is we're probably in range where we are. And there's even a small possibility, I wouldn't put it as high, but you have to keep multiple scenario potential open. If you have a major demand destroying event, September, October, you could even be below this shortfall floor level. That will be an absolute buying opportunity in the metals space, but that will be a situation where people have to sell anything because they've got to for margin call reasons and a variety of other reasons. Don't forget, Russia sold some gold. I think Turkey sold some gold during Hormuz when they needed to just deal with quick liquidity. So people that have to. And it's the stuff that's always wanted that gets sold, and it can dip in price during that period.
Francis Hunt's charts keep delivering the same quiet message. The big structural shift is already underway, even if the final explosion refuses a tidy calendar date, by sticking strictly to technical patterns rather than chasing the loudest price target. He shows why the current consolidation is simply the market digesting an historic advance while the underlying stress in debt markets continues to build. The window for disciplined positioning is open, yet it won't stay open forever. The question that remains is simple. When the next decisive break arrives, will you already be on the right side of it? Let us know your thoughts in the comments below. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.